What does it really mean when someone says we're in a bull market or a bear market? Alex, an eager young investor, finds himself in a coffee shop, surrounded by conversations buzzing about the stock market. He sips his coffee while scrolling through his social media feed, where terms like bull and bear appear in countless posts. But for Alex, these terms feel more like code than real concepts. He recalls his recent chat with a friend who excitedly claimed, "We're in a bull market. You should invest now." But what did that even mean? Alex imagines a stock chart with a wavy line going up and down. He wonders if the bulls are literally charging forward, while bears are lurking, ready to swipe at his investments. And here's the surprising part. The terms actually stem from the way these animals attack. A bull thrusts its horns upward, symbolizing rising prices and optimism in the market. This is the essence of a bull market. On the other hand, a bear swipes its paws downward, reflecting falling prices and a more pessimistic outlook. That's a bear market. As Alex contemplates this, he feels a mix of curiosity and confusion. Why should he care? Understanding whether we're in a bull or bear market could influence how he approaches investing. It's not just jargon. It's a way to gauge the overall mood of the market, which can lead to smart decisions down the line. With questions swirling in his mind, Alex decides it's time to dig deeper and finally uncover the true difference between these two market conditions. Alex had always heard the phrases bull market and bear market thrown around in conversation. But on this sunny afternoon, sitting at a cafe with a friend who was knee-deep in investing, he decided to dig deeper. "What exactly is a bull market?" he asked, curiosity lighting up his eyes. His friend leaned in, eager to explain. "Picture this. Imagine a herd of bulls charging forward, their heads held high and their horns pointed to the sky. That's what a bull market feels like. Prices are on the rise, and everyone's feeling optimistic." Alex nodded, visualizing the bulls. But what exactly made them charge? Well, when we talk about rising prices, we're usually referring to major indices like the S&P 500 or NASDAQ, which reflect the overall performance of stocks. In a bull market, those indices are climbing, often by 20% or more from recent lows. It's like a confident stride that shows investors are buying in, believing that the economy and their investments will keep flourishing. "Interesting," Alex replied. "But what drives this optimism?" It's usually a combination of strong economic indicators. Think about low unemployment rates. When people have jobs, they spend money, which boosts businesses. And increasing consumer spending, that's like fuel for the fire. As companies earn more, their stock prices go up. And the cycle continues. It's a positive feedback loop. His friend added, and here's the surprising part, this optimism can be contagious. As more investors jump in, they create even more demand, pushing prices higher. "So a bull market is more than just rising prices," Alex said, piecing it together. "It's about the overall economic health and the psychology of investors." "Exactly. And it can last for years, but it can't last forever," his friend cautioned. Understanding these cycles is key to navigating the markets. As Alex digs deeper into the world of investing, the excitement of the bull market starts to settle. But just as they're reveling in the upward momentum, a new term catches their attention: bear market. What is that? And why does it sound so ominous? Alex recalls a conversation with their friend Jamie, who once described a bear market as the opposite of a bull market. In a bull market, prices soar because optimism fuels buying. But in a bear market, it's like a dark cloud looms over the market. Prices sink, often for a prolonged period, typically defined as a decline of 20% or more from recent highs. But here's the surprising part. It's not just about the numbers. The atmosphere changes too. Imagine this. You're at a lively dinner party. Everyone's laughing, sharing stories, and the mood is electric. That's the bull market, filled with enthusiasm and confidence. Now, picture a sudden thunderstorm rolling in. The laughter fades, and people start to leave, heads down, eyes darting nervously. That's the bear market. It's driven by pessimism, often triggered by economic downturns, rising unemployment, or geopolitical tensions. Take 2008 as a stark illustration. After the housing bubble burst, fear gripped investors. Stocks plummeted, and the economy faced a recession. People held onto their cash, worried about their jobs and financial stability. The market reflected that anxiety, dragging prices down for months, even years. So while a bull market thrives on hope and growth, the bear market feeds off fear and contraction. Understanding this shift in sentiment is crucial for anyone looking to navigate the markets effectively. And with that understanding, Alex feels a little more prepared for whatever may come next in their investing journey. As Alex sits on the edge of his bed, staring at the flickering screen of his laptop, he begins to connect the dots. The numbers are clear, the market is down, and fear is palpable. He recalls the headlines he scrolled through just a few months ago, painted in bright colors, touting record highs and promises of prosperity. Now the mood has shifted dramatically. The same news outlets are drenched in red, warning about impending doom. But here's the surprising part. It's not just about the price movement. It's about the emotions fueling these markets. In a bull market, investors are riding high on a wave of optimism. It's like being at an amusement park, where every ride is a thrill and everyone is cheering. Investors feel confident, even invincible. They see prices climb and believe they will only go higher. This is the greed that drives the market up, pulling in newcomers and encouraging seasoned investors to take risks they wouldn't normally consider. Little do they know, this rush can lead to bubbles that eventually pop. Conversely, in a bear market, that euphoria flips to dread. Picture a roller coaster that's suddenly plunged into darkness. Investors are gripped by fear, pulling back their funds and second-guessing every decision. They watch prices fall and panic sets in, causing them to sell off assets at a loss to avoid further declines. This emotional spiral can create a vicious cycle, where fear begets more fear, leading to an even deeper market downturn. Understanding this emotional landscape is crucial. Markets aren't just numbers, they're a collective reflection of human psychology. So, the next time you hear about a market shift, remember, it's not only about what's happening with prices, but also about how people are feeling. The dance of greed and fear shapes the market more than any technical analysis ever could. As Alex dives into the history of bull and bear markets, he discovers that these market conditions are like the seasons of the economy, each leaving a mark on investors and society. Take the dot-com boom of the late 1990s, for example. Fueled by excitement and the promise of the internet, stock prices soared to incredible heights. Investors caught in the euphoria poured money into tech companies, many of which had no profits to show. It was a classic bull market, characterized by optimism and rising prices, where the mood was infectious and everyone seemed to be winning. But here's the surprising part. This exuberance eventually gave way to the bear market that followed. By the early 2000s, reality set in. Companies that couldn't deliver on their lofty promises faced plummeting stock values, leading to massive losses for investors. The sense of security during the bull market turned into panic as the market crashed, and many folks found themselves grappling with the fallout of their investments. Fast forward to 2008, and we see another stark example. The housing market, which had been on a bull run, collapsed due to risky lending practices and overvalued properties. The aftermath was a bear market that sent shockwaves across the globe. The economy stagnated, and millions lost their jobs and homes. This time, it wasn't just investors feeling the pain. Entire communities bore the brunt of the downturn. Through these historical moments, Alex realizes that both bull and bear markets are part of a larger economic cycle. Understanding their impacts helps investors navigate the emotional roller coaster and prepare for whatever comes next. As he reflects, he knows that recognizing these patterns can empower people to make informed decisions in their financial journey. As Alex sits at the cafe, his laptop open and charts glaring back at him, a realization begins to dawn. He recalls the stories of the past few months, the euphoria of the bull market, where prices climbed like a kite soaring into the sky, followed by the sudden drop into bear territory, where the atmosphere turned as heavy as lead. But now, he starts to see the bigger picture. Markets are cyclical, much like the seasons. Think of spring when everything blooms, representing a bull market filled with optimism and growth. It's a time when investors feel confident and they flock to buy stocks, driving prices higher. Then comes summer, where the market may plateau, still basking in the warmth of gains, but showing signs of fatigue. Then, as fall approaches, the leaves begin to turn, mirroring the transition into a bear market. Investor sentiment shifts, fear replaces greed, and prices start to tumble. It's a period that can feel disheartening, but Alex understands now that this is just part of the cycle. It's essential to recognize these signs, the early indicators of slowing growth, the whispers of inflation, or rising interest rates, because they often precede the shift from one phase to another. By grasping these cycles, investors can adjust their strategies accordingly. In a bull market, they might take a more aggressive approach, capturing opportunities, while in a bear market, they might choose to protect their investments, focusing on safer assets, or even waiting for better buying opportunities. And here's the surprising part. Understanding these cycles doesn't just prepare investors for the inevitable ups and downs. It empowers them to make informed decisions rather than reacting out of fear or excitement. Now, with this knowledge, Alex feels ready to navigate the markets more confidently. If you'll never look at a plane the same way,